Welcome to the Deep Dive, the show where we slice through the complex layers of information to bring you the essential insights from the most compelling reports and research. Today, we're embarking on a journey into a world that, well, at first glance, might seem incredibly niche: dry bulk shipping. But trust me, this sector offers a surprisingly potent lens through which we can clearly view the intricate, interconnected web of global economics, geopolitics, and even the accelerating impact of climate change. Our specific mission for this deep dive is to unpack the Q2 2025 newsletter from Precious Shipping Public Company Limited, or PSL, a significant player in the dry bulk arena. We're not just reading a report, we're using it as a launchpad to understand PSL's critical financial performance, navigate the swirling currents of current market conditions, and unravel a truly fascinating array of global factors that are actively shaping the entire dry bulk shipping industry. We'll be hunting for those crucial nuggets of knowledge, the surprising facts that truly stick with you, and ultimately what all of this means for you, our listener, to be truly well-informed about the often invisible yet powerful forces dictating global trade.
Exactly. And this isn't just, any corporate update. PSL's detailed newsletter actually provides us with an exceptional window into both the micro and macroeconomic forces constantly at play. We're talking about everything from the remarkable precision they show in managing the daily operational costs of individual ships, right up to the intricate, often high-stakes dance of international trade policies, the latest geopolitical tensions, and the ever-tightening grip of environmental regulations. It's a comprehensive, almost panoramic look at an industry that, while frequently out of sight, is undeniably foundational to the very fabric of the global economy.
Okay, let's dive right in then. Section 1 is PSL's recent performance and position. They title it Navigating Choppy Waters, which seems apt. Let's unpack their Q2 2025 performance, starting with their financials in US dollar terms. The initial numbers here tell a story of careful management, but against a really challenging market backdrop. Their average daily earnings per ship in Q2 2025 came in at USD 10,132. Now that's a noticeable dip, quite a significant one actually, from USD 13,483 in Q2 2024. But what really jumped out at me, and where I think it gets genuinely interesting for you, our listener, is how incredibly well they manage their daily operating costs. At USD 5,135, that's actually lower than their own ambitious target of USD 5,670 for 2025, and is also below what they achieved in Q2 2024, which was USD 5,226. What does that efficiency tell you about their internal operations when facing such a tough market?
Well, it really highlights this dual challenge, doesn't it? What stands out here is a classic tale of two distinct forces at play. On one hand, PSL's ability to not just meet but exceed their cost-saving targets, even bringing down operating costs year over year, is a powerful testament to their operational discipline and a highly efficient management team. It speaks to robust internal controls. However, the significant drop in those average earnings, which then translated into a sharply lower EBITDA of USD 13.34 million, that's down from over USD 22 million a year ago, and ultimately a net loss of USD 1.32 million.
Right.
Well, that paints a very clear picture of a weak freight market.
Right.
This isn't just a tale of two numbers. It underscores a fundamental vulnerability. Even near-perfect internal execution can't fully insulate a company from brutal external market headwinds. It's a stark reminder that in dry bulk shipping, macro trends often trump micro efficiency. You can be the best-run ship, but if the tide is going out, you're still going down.
So it sounds like even the best internal management can't completely counteract overwhelming external market forces. That's a tough position to be in. Now, to delve a bit deeper into what this looks like on a vessel-specific level for you, our listener, the newsletter provides a really useful breakdown of earnings by ship size. There's handy. Ships, for example, earned USD 9,609 per day. Supermax vessels came in at USD 10,349, and the larger Ultramax ships earned USD 11,285. This isn't just a list of numbers. It's key because it helps us understand which specific segments within their diverse fleet are feeling the pinch the most, and how different vessel sizes are performing in the current challenging market environment.
Precisely. It shows the nuances within the broader market downturn. Not all segments are hit equally hard, though clearly all were down significantly year over year.
Okay, shifting gears now to their consolidated financial performance, viewed through the lens of Thai baht terms. This adds another layer of complexity, doesn't it? The picture for Q2 2025 shows a net loss of Baht 43.31 million. This stands in stark contrast to a net profit of Baht 529.52 million in Q2 2024. And when we look at the first half of 2025, it's a net loss of Baht 183.55 million compared to a substantial Baht 939.00 million profit in the same period last year. These are truly significant swings in profitability.
They really are. And a compelling aspect here is how currency fluctuations act as a powerful, sometimes unpredictable multiplier of market trends. The net vessel operating income was 28% lower, which the report clearly attributes to two factors: the weak freight market, as we've just discussed, and the appreciation of the Thai baht against the US dollar.
So the strong baht actually hurt their reported income when converting from USD.
Exactly. But conversely, and this is an interesting counterpoint, the stronger baht actually worked in their favor by reducing vessel running and administrative expenses when those were measured in local currency. So the currency is truly a double-edged sword here, impacting both revenue conversion and expense reduction. This immediately brings to mind a critical question. How do international companies in this sector, implement hedging strategies to stabilize their reported earnings against such significant currency shifts? These clearly impact their overall profitability and the market's perception of their performance.
That's a crucial point about hedging. Given the volatility we're seeing, what are the most common strategies PSL, or companies like them, would typically employ? Is it primarily through forward contracts, currency options, or some kind of mix?
It's typically a sophisticated mix, yeah. Large international companies like PSL would almost certainly use a combination of currency forward contracts to lock in exchange rates for future expected revenues and expenses. They might also use options to provide more flexibility, allowing them to benefit if the currency moves favorably but protecting them if it moves against them. And then there are natural hedges, where they try to match their foreign currency revenues with foreign currency expenses as much as possible, maybe paying some costs in USD if they earn in USD. But as this report clearly illustrates, even with robust hedging strategies, significant currency movements can still create substantial reported losses or gains, especially for a company with global operations and dollar-denominated contracts reporting in a local currency like the baht. It's an ongoing, complex challenge.
Right, hedging can only do so much against major swings. And to tie it back to the specific figures for you, our listener, the finance costs were actually lower in Q2, which is good. However, exchange losses amounted to a substantial body, 63.44 million in Q2 alone. This directly reflects the baht's strength impacting their US dollar liabilities, like perhaps USD loans. Looking at the first half of the year, there was a gain of Baht 25.53 million from one vessel sale, which offered a small but notable offset against the larger losses. It really underscores how many different complex moving pieces there are in global shipping finances, far beyond just freight rates.
Absolutely. It's never just about the headline rate per day.
Now, despite these financial headwinds, PSL has been racking up an impressive list of awards and honors. This section of the newsletter really highlights a strong, consistent commitment to sustainability and good governance. For instance, they achieved their second recertification under Thailand's Collective Action Against Corruption, or ACARE program, maintaining continuous membership since November 2018. They also received the Best Sustainability-Linked Bond Transportation Award. That sounds significant.
It is significant, and it shows that these ESG accolades aren't just for, good PR. They're becoming a strategic imperative for long-term financial health and access to capital. Earning consecutive carbon neutral and carbon footprint certifications, achieving an AA ESG rating from the Stock Exchange of Thailand, and being ranked in the top 12% globally for transportation in S&P's Corporate Sustainability Assessment, these all demonstrate a profound and consistent commitment to environmental, social, and governance principles.
So it's really embedded in their strategy.
It appears so. And this is vital because robust ESG performance is increasingly correlated with long-term resilience. It opens doors to sustainable finance opportunities, like that award-winning bond, and it can significantly mitigate future regulatory risks, especially in an industry like shipping that is facing intense scrutiny over its environmental impact. These aren't just badges of honor. They represent a core, future-proofing business strategy.
I completely agree. Imagine being classified as excellent for corporate governance for 15 consecutive years, from 2010 to 2024, or earning a perfect annual general meeting assessment score for 7 years straight. These aren't easy feats to accomplish year after year. It speaks volumes about the deep structural integrity, consistent leadership, and robust ethical framework within the company. It's a foundation that can, hopefully, help weather these financial storms.
It certainly provides a degree of confidence for investors and stakeholders, suggesting stability and good practice even when the market cycle turns down.
Okay, let's now look at how PSL's fleet performed relative to market benchmarks, this concept of market segmentation. The Baltic Handysize Index, or BHSI, averaged 588 points, with an average time charter, or TC, rate of USD 10,592 per day. BSL's handy-size fleet, however, earned USD 9,609 and underperformed the BHSI TC rate by 9.3%. Similarly, their super-ultra fleet averaged USD 10,842 per day, underperforming the Baltic Supermax Index, or BSI, by 10.8%. The DSI averaged 962 points with an average TC rate of USD 12,160. On the surface, this might look, well, a bit concerning, right?
It might if you just look at the headline numbers, but what's truly notable here is the crucial piece of context the newsletter explicitly provides. It states that PSL's small handy ships and Supras are actually 15% smaller than the standard index ships that these benchmarks are based on.
Okay, so the ships used for the index are bigger.
Exactly. This size difference is key. Smaller vessels often operate in different market niches, maybe calling at ports with draft restrictions, carrying different types of cargoes, which can lead to distinct earning profiles and market dynamics compared to their larger counterparts. So this distinction helps us understand some of the apparent underperformance relative to the broad index. It's a reminder to think critically beyond just headline numbers. It encourages ensuring we don't jump to conclusions without considering the specific context of their fleet. It's not necessarily underperformance in their specific market segment, but a difference compared to the index's segment.
That makes perfect sense. So for you, our listener, it's about comparing apples to apples, or in this case, maybe a 15% smaller apple to a standard-sized index apple. It's a vital detail that provides much-needed context and prevents misinterpretation.
Precisely. Context is everything in shipping benchmarks.
Now, one key aspect of PSL's long-term business model is their charter strategy. They seem to balance spot market exposure with longer-term contracts. They currently have 20.4% of their 4-year rolling book on fixed long-term charters. This secures a visible revenue stream of USD 200.52 million. We see that 40% of their available days in 2025 are fixed, decreasing gradually to 12% by 2029. The average time charter rates for these contracts range from USD 12,726 per day in 2025 to a pretty healthy USD 14,371 per day in 2029.
Yeah, those forward rates look quite decent. This strategy powerfully underscores a preference for revenue predictability over pure spot market exposure. While variable rate charters allow them to capture the upside in truly strong markets, these fixed-rate contracts provide a crucial floor during periods of market weakness, like the one we're seeing now. It effectively dampens volatility and offers greater financial certainty for long-term planning and capital investments. It's a classic balancing act in shipping risk management, aiming to secure a base level of income regardless of the often dramatic daily market fluctuations.
So it's about smoothing out the peaks and troughs.
Exactly. This approach speaks to a company focused on resilience and strategic stability, not just chasing the highest possible spot rates at any given moment.
So, while the recent financial results were challenging due largely to external market conditions, these long-term contracts provide a solid base for future revenue, a bit like having a steady job in an otherwise fluctuating gig economy. It helps buffer against the market's unpredictable nature.
A good analogy. It provides a baseline income stream.
And just a quick note for those of you interested in more direct engagement and insights, PSL will host its next Set Opportunity Day virtually on August 13th, 2025 at 15:15 hours Thailand time. It's an excellent opportunity to engage directly with the company leadership and hear more about their Q2 results and outlook. For Q1, they had 185 participants, so there's clearly a strong appetite for these updates.
Definitely worth tuning in if you follow the company closely.
Okay, let's now transition to the broader dry bulk market dynamics. Section 2, Global Dry Bulk Market Dynamics. Winds of change. This is where we zoom out. As we always emphasize on this show, this market is a direct reflection of global economic health and geopolitical stability. There's been a significant and frankly quite positive development on the trade front. The U.S. and China have finally agreed to significant tariff reductions. The U.S. cut theirs from a staggering 145%, which is just unbelievable, down to a still high but much improved 30% on Chinese imports. And China reciprocated with a 10% reduction on U.S. goods. This pause and eventual agreement has certainly boosted trade between these two economic giants, with the newsletter noting trade flows even surpassing pre-tariff levels.
Yes, this de-escalation of trade tensions is undoubtedly a major positive for global trade flows, acting as a significant tailwind. The IMF, in its July report, actually raised global GDP growth forecasts for 2025 to 3.0%, for 2026 to 3.1%, largely crediting these reduced tariffs and fiscal expansion across several major economies. What's truly compelling here, though, is the stark country-level divergence we're observing. while U.S. growth forecasts for 2026 were revised up to 2.0% and China's 2025 forecast lifted by 0.8 percentage points to 4.8%.
China at nearly 5% is quite strong.
It is, but Canada, in contrast, is likely in a technical recession. This immediately brings to mind a critical question. How will these uneven economic recoveries across different regions impact specific dry bulk demand and reshape existing trade routes? We're certainly not seeing a uniform global upswing. It's patchy.
That's a crucial point about uneven recovery. It implies that while the global pie might be getting bigger, some slices are growing faster than others, directly impacting where ships need to go. And here's where it gets really interesting for future demand, though perhaps under grim circumstances. The potential for massive reconstruction after multiple ongoing wars, the newsletter specifically mentions Gaza, Yemen, Lebanon, Syria, Iran, and Ukraine, could add, and I quote, a couple of percentage points to world GDP growth for several years. This isn't just theory. It would significantly boost demand for construction materials like steel, cement, and aggregates, all of which travel on ships of PSL size. That's a huge potential demand driver lurking in the wings, assuming peace breaks out.
A difficult assumption, but yes, a potential driver. And if we connect this to the bigger picture, we see other powerful, often contradictory forces at play. Extreme weather events, for instance. The persistent drought and recent storms in China are severely impacting wheat crops, expected to be 5% lower. This could very well lead to much larger grain imports into China, often from distant origins like the Americas or Australia, pushing up ton-mile demand.
Right, longer voyages for the same commodity.
Exactly. And for our listeners, when we talk about 10 miles, think of it as the amount of cargo multiplied by the distance it travels. It's the true measure of demand for shipping services, not just the volume of goods moved. So, a ship carrying a small amount of cargo a very long way contributes significantly. Simultaneously, the surging demand for electricity globally, driven not only by heat waves, but increasingly by the insatiable appetite of AI data centers, we'll get more into that later, might see thermal coal playing a more active role again in power generation. That could further influence dry bulk movements. The interplay of climate, technology, and geopolitics creates a truly complex, dynamic demand picture for dry bulk.
It's almost like a perfect storm of disparate factors shaping demand. It's not just one simple trend. And then on the supply side, the newsletter highlights this paradox. Despite the existing world fleet being the oldest it has ever been, ship recycling remains abysmally low. It's apparently about 75% below the ruts we saw in the 2010s. This means many older, less efficient ships are still stubbornly in service. This could bottleneck future environmental compliance efforts and effectively keep supply higher than might be ideal for freight rates, couldn't it?
It definitely could. It keeps capacity in the market that might otherwise be retired, especially capacity that will struggle with new environmental rules. It's a strange dynamic, an aging fleet that just won't retire quickly enough.
Now, the Baltic Dry Index, or BDI, the key barometer for the health of the dry bulk market, is influenced by an incredible array of factors, a true mosaic, as the newsletter calls it. While the U.S.-China trade truce is generally positive, it has complex ripple effects. China's exports, for instance, grew more than expected despite a drop to the U.S. Apparently, this was partly thanks to quietly exempting some U.S. goods from tariffs even before the deal, and also cutting lending rates to support its domestic economy.
Right. China has its own internal levers it pulls. And a particularly compelling aspect here, tying back to what you just said, is the ongoing sluggishness in the ship recycling market. Clarkson's reports that recycling sales in the first half of 2025 are running at historical lows, approximately 75% below the average run rate across the 2010s in deadweight terms. And for context, deadweight tons, or DWT, refers to a ship's total carrying capacity: cargo, fuel, water, crew, stores, everything. It's the measure of the ship's size. So significantly less old tonnage is leaving the fleet. Meanwhile, we're seeing major container lines proactively managing supply by laying up ships, basically parking them, to maintain profitability.
A lesson dry bulk hasn't really learned collectively.
Not on the same scale, no. Dry bulk is much more fragmented. This leads us to wonder, what happens when stricter environmental regulations, like those coming from the IMO in 2028, start forcing these older, less efficient ships out of service? Especially given the current, historically low recycling rates, there's a potential bottleneck looming, and it's getting closer. The supply side could tighten quite suddenly.
So this low recycling rate effectively keeps more ships in the water, even as demand fluctuates, creating a potential clash with stricter environmental rules down the road. Beyond trade, global economic stability is clearly under significant pressure. Moody's, the rating agency, downgraded the U.S. due to its government debt, approaching a mind-numbing $37 trillion. That number is just staggering. And JP Morgan's Jamie Dimon, a prominent voice in finance, can't rule out stagflation for the U.S., citing huge risks from geopolitics, deficits, and persistent price pressures. But amidst all this gloom, consumer confidence in the U.S. actually jumped by 12.3 points in July, the biggest monthly gain in 4 years. So what does it mean when you have such incredibly contradictory signals about the global economy? How do you make sense of that?
It means forecasting is exceptionally difficult right now. This period is indeed characterized by striking contradictions. On one hand, China's manufacturing PMI, a key indicator, dropped below 50, signaling contraction, particularly in external demand. This suggests a slowdown in the world's factory. Yet on the other hand, India's steel sector is poised for truly significant growth, with ambitious plans to reach 300 million metric tons of capacity by 2030. That offers a new and substantial market for iron ore miners, potentially shifting trade flows.
So maybe less reliance on China, more on India for certain commodities?
Potentially over the long term. We also see critical shifts in energy trade. Southeast Asian economies like Vietnam are becoming increasingly important demand centers for thermal coal, even as China and India reduce their seaborne purchases. This seems driven by robust domestic production in China and India, and maybe tepid industrial demand there too. These regional shifts in commodity demand are absolutely crucial to understanding the future of dry bulk trade patterns. It highlights a potential decentralization of demand away from just China.
That's a key trend to watch. And on the domestic U.S. front, Trump's big, beautiful bill, that's the tax cut bill, is projected to add a colossal $2.42 trillion to U.S. budget deficits over the next decade, according to the Congressional Budget Office. This raises serious concerns about increasing inequality in the U.S., with tax breaks primarily aimed at the rich, and potential long-term impacts on the dollar's strength if the Federal Reserve were to lower interest rates under such fiscal pressure. Meanwhile, China's property sector, a perennial concern for global commodity markets, is showing early signs of stabilization. New construction starts actually rebounded, which could potentially boost demand for key industrial imports like iron ore, copper, and bauxite.
Yeah, any positive sign from China's property sector is usually seen as good news for dry bulk, given how much material it consumes. The IMF's upward revision of global GDP forecasts for 2025 and 2026, driven by stronger than expected demand and lower tariffs, certainly provides a backdrop of cautious optimism, despite all the risks. However, let's also look at the supply side's forward trajectory again. The order book to fleet ratio, that's the new ships ordered compared to the existing fleet, stood at 10.56% at the start of Q2 2025. That's the highest it has been since 2021. Critically, this figure now roughly matches the percentage of the current fleet that is 20 years or older, which stands at about 10.2% of the total fleet by deadweight.
So new orders are basically just replacing the oldest ships.
Roughly, yes. This suggests tighter short-term supply fundamentals through 2028, as these new orders effectively replace older ships nearing their end of life, rather than simply adding significant net new capacity without corresponding recycling. It's a potential balancing act between new deliveries and old vessels departing, which could support freight rates if demand holds up or grows.
Interesting dynamic. Finally, let's look at the BDI's performance in the first half of 2025. It averaged 12,290.3 points. That's a significant drop, down 29.72% compared to the first half of 2024. All dry bulk sectors underperformed year over year, with Capes and Supras seeing the largest falls. However, the newsletter points out that rates did improve in early July, led by Capesize activity, partly due to strong long-distance bauxite shipments from Guinea. So a little bit of an uptick more recently.
Yes, Guinea bauxite has become a major long-haul trade, supporting the larger Capesize vessels. It's a welcome bright spot and an indicator of those shifting trade patterns we talked about.
Okay, now the newsletter does something interesting. It looks back at historical market periods to provide context. 2003-09, 2010-20, 2021-22, and 2023-24. To truly understand today and perhaps even glimpse tomorrow's trends, we often need to look at history, right? Time charter rates in the period 2003-09 were sky high, especially for Capesize vessels. Panamax and Supramax rates were nearly 3 times higher than in 2010-2020, a real boom time. But here's the interesting part. Even though demand growth in ton-miles steadily declined across these periods from 5.6% annual growth in 2003-09 down to a sharp drop to just 1.6% in 2021-22, PSL still managed to produce very good results in both 2021 and 2022. How did that happen?
Well, ton-mile demand did rebound strongly to 5.1% in 2023-24, closely approaching levels last seen 2 decades ago. This increase was largely due to wars and trade route disruptions.
The inefficiency factor?
Exactly. The ongoing Red Sea rerouting, for instance, with renewed Houthi attacks sinking 2 bulk carriers in early July, continues to keep transit levels through the Suez Canal historically low, down approximately 60% versus the 2023 average. This forces ships to take significantly longer routes around the Cape of Good Hope, effectively absorbing available supply and dramatically boosting ton miles, even if the actual volume of cargo hasn't increased proportionally. It's like needing more trucks because every single truck has to take a massive detour for the same delivery. It artificially tightens the market.
That's a truly counterintuitive but critical point for you, our listener, to grasp. Longer voyages due to geopolitical conflicts actually increase the demand for shipping capacity, even for the same amount of cargo, because ships are tied up for longer periods. It's a direct link between global instability and market dynamics.
Precisely. It reduces the efficiency of the global fleet. Another fascinating aspect from these historical comparisons is that order book to fleet ratio again. It was quite high in 2003-09 at 25.9%, and even higher in 2010-20 at 32.2%. That meant huge waves of new ships were coming. But then it dropped sharply to just 6.5% in 2021-22. Now it's rebounded to 10.6% at the start of Q1 2025. And critically, as we said, this percentage now roughly matches the size of the 20-plus-year-old fleet, around 10.2%. This suggests tighter short-term supply fundamentals through 2028. It indicates a potential for healthy recycling in the coming years to balance out the new deliveries, which is key for market stability. Less risk of a massive oversupply situation like in the past.
That makes sense. And further tightening that capacity is the average vessel speed. It has also steadily declined, hasn't it?
Yeah.
From 13.5 knots back in 2003-09 down to 10.76 knots in the first half of 2025. That's quite a drop.
It is, and it effectively reduces the overall fleet capacity available to carry cargo, making each ship less productive in terms of miles covered per day. Slower ships mean you need more ships for the same amount of trade.
Plus, the newsletter touches on the proposed U.S. Ships Act. This could introduce penalty taxes on Chinese-linked ships, potentially adding significant costs up to $1 million per voyage for large vessels under USTR Section 301. This could further complicate trade flows and operational economics for a significant portion of the global fleet, couldn't it?
Absolutely. It adds another layer of cost, uncertainty, and potential trade friction, especially impacting trans-Pacific routes if implemented broadly.
Okay, let's zoom in now specifically on the supply-side developments and the regulatory shifts. Section 3, supply-side and regulatory shifts in shipping, the future fleet. The world fleet actually grew by a modest 1.57% in the first half of 2025, reaching 1,045.26 million deadweight tons. So some growth. But here's the kicker, and it's a huge one you flagged earlier. New build activity for bulkers in the first half of 2025 slowed dramatically. Just 9.73 million deadweight tons of bulk carrier contracts were placed. That's a massive 73.04% drop from the same period last year. And it's a level that was last seen way back in the first half of 2016, a historical low for new orders. Why the reluctance to order new ships?
It's likely a combination of factors. Uncertainty about future market direction, uncertainty about which fuel technology will be dominant for meeting future environmental regulations, high shipbuilding prices, and maybe tighter financing conditions too. This is a critical insight and a powerful signal for the coming years. It indicates a potentially constrained future supply. While there might be some incremental fleet growth from scheduled deliveries of vessels already ordered years ago, the sharp decline in new orders, especially in the geared segment comprising supermaxes and handy sizes like PSL operates, well, that points squarely to a much tighter supply environment in the medium term, say 2027 onwards, as it takes a couple of years to build a ship.
Right, the ships ordered today won't hit the water for a while.
Exactly. This, coupled with increased off-hire time for ships going into dry docks for essential maintenance and retrofits, and the speed loss due to new environmental regulations, means the effective supply available to carry cargo is actually much tighter than what the raw fleet growth numbers might initially suggest. The actual capacity to move goods is being squeezed from multiple angles, creating upward pressure on rates if demand remains stable or grows.
So it's all about the effective supply, not just the sheer number of ships on the water. That distinction is key for understanding market tightness. Think of it like a highway. You might have a lot of lanes, ships, but if there are constant slowdowns, detours, or cars breaking down, regulations, maintenance, slow speeds, the actual number of cars that can get through in an hour, that your effective capacity drops dramatically.
That's a great analogy. It captures the dynamic perfectly.
And here's a major development for you to consider. A real regulatory squeeze on the fleet that is already in effect, the Energy Efficiency Existing Ship Index, or EEXI. This came into force on January 1, 2023, and it's forcing many older vessels, particularly those built before 2011 with non-eco engines, to adopt engine power limitation, or EPL. This means they operate at significantly lower speeds to comply with efficiency requirements, even if they're physically capable of going faster.
Yes, and this has a direct and measurable impact on supply, effectively removing capacity from the market, just like slower driving reduces highway capacity. The newsletter provides some compelling figures. Each 1 knot reduction in speed across the world fleet reduces effective supply by 5.5%. That's a huge leverage effect. If all pre-2011 geared dry bulk ships, which account for about 161.6 million deadweight tons of the total 376.8 million deadweight ton geared fleet, were to reduce speed by an average of 1.5 knots due to EPL measures, that would lead to an 8.25% supply reduction within that segment. This translates into an effective supply loss of 13.33 million deadweight tons, or 3.5% of the total geared fleet capacity. That's substantial.
Wow, just from slowing down older ships.
Exactly. And adding to this, mandatory special surveys, or SS, these are like major checkups required every 5 years, take ships out of service for anywhere from 15 to over 40 days for critical inspections and maintenance. The number of ships undergoing these surveys was high in 2025, the most since the first half of 2022. This further reduces available capacity as ships literally disappear from the active fleet for weeks at a time.
So, combining these factors, the EPL speed reductions and the time lost for special surveys, the geared bulker fleet is projected to actually shrink by 2.3% this year, following a 1.7% decline in 2024. That's a very tangible and significant reduction in available carrying capacity, which could lead to tighter market conditions, couldn't it?
Absolutely. The newsletter estimates a total net supply loss of 5.8% for geared bulk carriers when you combine these effects. This is a significant factor in tightening the market and strongly supports the potential for stronger market conditions ahead by substantially reducing the available carrying capacity. It's a clear positive for freight rates in the geared segment, assuming demand doesn't collapse.
It's a regulatory squeeze, creating a supply-side opportunity for owners of modern, efficient ships. On that note, and aligning with these market dynamics, PSL continues to manage its fleet renewal strategically. They had one 5-year-old Ultramax join their fleet in April of this year. They're constantly looking to opportunistically add to their fleet while simultaneously selling older, less efficient ships. Seems like the right strategy now.
It certainly does. This strategy aligns perfectly with our earlier discussions on EEXI and special surveys. By actively adding newer, more efficient vessels and divesting older ones, PSL is positioning itself to not only comply with the increasingly stringent environmental regulations, but also to reduce operational costs, enhance fuel efficiency, and maintain a competitive edge, especially in what is clearly a tightening supply market for geared bulk carriers. It's a forward-looking, pragmatic approach to fleet management in a rapidly changing regulatory landscape.
Makes sense. Now, beyond current regulations like EEXI, the IMO, the International Maritime Organization, reached a compromise deal in April 2025 on new shipping emissions regulations. This seems like the next big wave. These are kind of midterm measures, and they're set to come into effect from 2028. They'll introduce global technical standards for marine fuel GHG intensity and a new carbon pricing structure. And crucially, they're moving to a well-to-wake basis for emissions evaluation. What exactly does well-to-wake mean?
It's a huge shift. Well-to-wake means measuring emissions from the very production of the fuel, its extraction, processing, and transport, all the way through to its combustion on the vessel. Previously, the focus was mostly tank-to-wake, just the emissions from the ship itself. Now it's the whole life cycle. It's like measuring your car's carbon footprint not just from the tailpipe, but starting from the oil rig, through the refinery, the pipeline, the tanker truck, right to your fuel tank, and then out the exhaust. It demands a holistic view.
That sounds incredibly complex to measure and enforce globally.
It will be. Under the new system, ships achieving an intensity below the mandated target will get surplus units, effectively carbon credits, while those exceeding the target must buy these surplus units from cleaner ships or buy remedial units, or RUs, potentially from the IMO itself, and the potential price is steep. These RUs could be priced at $100 per ton or even a staggering $380 per ton of CO2 equivalent, depending on how far they exceed the target. This immediately brings to mind a critical question. What will be the real financial burden on ship owners? And how dramatically will it accelerate the transition to truly alternative, low-carbon fuels across the global fleet? The cost implications are immense.
And the newsletter provides a sobering example of this impending financial burden. Using very low sulfur fuel oil, or VLSFO, which is the standard compliant fuel today, and having to buy these RUs, could cost a non-eco Cape-size vessel an additional $2,500 per day in 2028. That cost is projected to escalate dramatically to $15,000 per day by 2035 as the standards tighten even further.
$15,000 a day extra cost.
Just for the carbon pricing. What's more, the newsletter points out that even LNG, liquefied natural gas, which is currently the most adopted alternative fuel for new builds, won't meet the direct compliance target from 2031 if it's derived from fossil sources. That's a huge challenge. It potentially renders current green investments in LNG-fueled ships insufficient within just a few years unless they can source green synthetic LNG.
That's right. Fossil LNG still has significant well-to-tank emissions, especially methane slip. This level of carbon pricing will undoubtedly drive significant technology retrofits, major capital investments in new, compliant vessels, running on things like methanol or ammonia perhaps, and fundamental operational changes across the fleet. But the real overarching challenge lies in the availability, scalability, and pricing of truly low GHG intensity fuels that meet the stringent well-to-wake criteria. This is why the newsletter notes that tricky decisions on timing and technology are expected to dominate discussions at the IMO and among ship owners in the coming months and years. The industry is effectively being pushed into a very expensive and technologically uncertain future where the current best-guess solutions might not be the long-term answers. It's a massive gamble for ship owners ordering today.
A huge gamble indeed. Okay, we've spent a lot of time on PSL's financials and the immediate market and regulatory landscape. Now let's broaden our view significantly. Section 4 looks at broader global influences on shipping and economy, the web of interconnections. We've seen how geopolitics impacts trade routes, like the Red Sea, and this brings us to critical shipping choke points. The newsletter highlights their immense importance. 24% of world trade passes through the Malacca Straits, between Malaysia and Indonesia, 11% through the Strait of Hormuz, exiting the Persian Gulf, and 9% through the Suez Canal before the recent disruptions. These are incredibly busy and strategically vital arteries for global trade.
Acabsolutely. And what's truly compelling here is the increasing vulnerability of these choke points, not just to traditional geopolitics, but now also to the accelerating impacts of climate change. For instance, the Strait of Hormuz, through which 20% of the world's oil and gas passes, is a perennial flashpoint for Israel-Iran tensions. Any significant disruption there would send global energy prices soaring, affecting every corner of the economy and every shipping sector. But even canals like the Panama Canal, vital for north-south trade, have seen transits impacted by severe droughts linked to climate change, forcing ships to lighten loads or take longer routes. So the risks are multifaceted, combining geopolitical friction with environmental vulnerability.
It truly makes you realize how fragile global supply chains can be. Imagine your daily commute, but instead of one bottleneck, you have these critical intersections for everything that moves globally. A small disruption there can ripple through the entire system, affecting the cost and availability of goods in stores thousands of miles away.
It's a very interconnected system, and these choke points are the most vulnerable nodes.
The newsletter also mentions a significant global event, Pope Leo XIV's first address after taking over from Pope Francis. He powerfully continued his predecessor's legacy. He called for dialogue and peace, affirmed free speech, and appealed for an end to violence in Ukraine and Gaza, specifically calling for humanitarian aid to enter Gaza without obstruction. He also met with U.S. Vice President J.D. Vance and exhorted care for creation, directly addressing global climate change. How does this connect to shipping?
Well, while it might not seem directly related to shipping at first glance, these calls for peace, diplomatic resolution, and addressing climate change are absolutely foundational to global stability. Conflicts, as we've seen, directly impact trade routes by forcing rerouting, increasing insurance costs, and ultimately reducing demand for general cargoes. They disrupt the very fabric of trade. At the same time, if peace were to miraculously arrive, the demand for reconstruction materials, as we discussed, would be immense, boosting demand for bulkers. Similarly, climate action, as highlighted by the Pope's exhortation for care of creation, directly influences environmental regulations like the IMO's new standards we just discussed. His influence, therefore, indirectly but significantly shapes the broader environment in which global shipping operates, impacting everything from operational costs to demand patterns and even the ethical considerations for voyages.
So a moral and stabilizing influence on the global stage has real-world economic and operational implications. Now, something potentially game-changing. Small modular reactors, or SMRs. Could these be a future power source, maybe even for ships? Canada's Ontario province just greenlit a $20.9 billion plan to build new SMRs. They're being touted as a clean way to meet surging power demand, especially from artificial intelligence. These SMRs work on established procedures of cooling water under high pressure, a proven technology.
Right. SMRs for land-based power are gaining traction. What's truly fascinating, though, for the shipping industry is the concept of molten salt reactors, or MSRs, for commercial vessels. These are a different, more advanced type of nuclear reactor. A group led by Core Power Ltd. aims to launch a fission-powered vessel using MSR technology by 2035. However, while the molten salt reactor experiment did prove feasibility way back in the 1960s, the newsletter notes that commercialization for shipping is still decades away. The most recent report suggested another decade before even proof of concept could be ready for widespread adoption in maritime.
So not exactly around the corner then.
Not at all. This leads us to wonder, how quickly can this technology truly evolve and overcome the immense commercialization challenges, public acceptance hurdles, and regulatory hurdles needed to meet the ambitious decarbonization targets set by the IMO, especially targets set for 2030 and 2040? The timelines seem to be fundamentally at odds. Nuclear power for ships is a long-term prospect, not a solution for the next decade or two.
It certainly highlights that while the race for carbon-free propulsion is very real and nuclear power offers tantalizing long-term potential, the timeline for advanced nuclear options like MSRs is still quite long. This forces the industry to consider more immediate, albeit potentially less comprehensive, solutions like alternative fuels, methanol, ammonia, or efficiency measures like speed reductions in the interim.
Exactly. The immediate challenge requires immediate solutions, even if they aren't the final answer.
And speaking of power demand, get ready for this section on artificial intelligence. AI is driving an unprecedented surge in electricity consumption, with massive implications for global energy markets and therefore dry bulk. A single large data center can consume 1,200 megawatts. The newsletter says that's more than 90 times the energy consumed by a nearby township like Bessemer and 10 times the amount of energy used by all residences in Birmingham each year.
The scale is just mind-boggling.
And these facilities require clearing huge swaths of land, as much as 100 acres of forest, for a single large data center project. Boston Consulting Group estimates that data centers alone will account for a staggering 7.5% of all U.S. electricity consumption by 2030. That's an amount equivalent to the power needs of 40 million U.S. homes.
Wow. And this is where AI connects directly to dry bulk shipping in a profound, almost primal way. This immense and growing power demand is increasingly being supplied by gas and coal-fired plants, according to the International Energy Agency, potentially boosting demand for these energy cargoes, coal, and potentially LNG to be transported by sea. We're already seeing companies like Meta buying nuclear power from Constellation to fuel its AI needs. Microsoft's and Amazon's emissions are climbing due to their vast data center expansion, largely driven by increased electricity consumption. This makes us ask, how will the scramble for electricity to power AI shift global energy trade flows? What new infrastructure demands will emerge globally to support this power plants, transmission lines requiring steel, cement, copper, all moved by bulkers? And how will dry bulk shipping respond to carrying these critical energy resources and construction materials across continents? The sheer scale of demand is truly staggering, and it's a new, powerful driver for dry bulk that barely existed a few years ago.
It's like a whole new category demand just appeared. And to put an even finer point on it, a Trump administration report warns that blackouts in the U.S. could increase 100 times by 2030 due to this AI power demand. They blame the expected shortfall on closures of existing coal and natural gas power plants under previous policies. Meanwhile, China is also secretly building massive AI data centers in the Gobi Desert, signaling a truly global race for AI power infrastructure that will undoubtedly impact energy and raw material demand for decades to come.
A huge, energy-hungry beast has been unleashed.
Shifting now to the political landscape, particularly the potential impact of Trump 2.0 as the newsletter frames it. This brings a continuation of art of the deal negotiating tactics, which historically have caused global indigestion and immense uncertainty. His big, beautiful bill, the tax cuts, is projected to add trillions to the U.S. deficit, exacerbating inequality and raising concerns about inflation and the dollar.
Yes, and from a shipping perspective, his trade strategy remains profoundly disruptive. While an initial truce with China did see tariffs slashed, tensions quickly reignited, with China accusing the U.S. of seriously violating the deal. Critically, Trump has publicly threatened new tariffs on numerous countries. The newsletter lists potential rates like 26% on India's textiles, 50% on Brazil, 35% on Canada, 30% on the EU and Mexico, and 15% on Japan. The key takeaway here isn't the specific percentages, which might change, but the profound uncertainty and instability this constant threat and imposition of tariffs creates for trade flows and supply chain planning. It forces companies to constantly reroute, reconsider sourcing strategies, and hedge against sudden policy shifts. It directly impacts dry bulk demand and routes globally. It's an environment of constant flux requiring extreme adaptability.
So predictability goes out the window.
Completely. And the economic consequences are tangible and far-reaching. The U.S. economy saw a contraction in Q1 2025, partly due to weaker consumer spending and trade, potentially linked to this uncertainty. Companies like GM reported over $1 billion profit hit from previous rounds of tariffs.
So what does this all mean for you, the consumer, when these policies are enacted? Ultimately, these tariffs typically mean higher costs, right? American businesses and consumers end up bearing the burden through increased prices on imported goods, or companies absorb the hits, potentially leading to job cuts or reduced investment. It's rarely the exporting country that pays the full price.
That's generally the economic consensus, yes. Tariffs act like a tax, mostly paid domestically.
The newsletter then turns to the stark reality of geopolitics, wars, inflation, and more. It's very blunt. There are no winners in any wars, only losers.
We're talking about multiple active conflicts around the globe. Israel-Iran tensions flaring, the ongoing devastation in Gaza, conflicts involving Yemen, simmering India-Pakistan issues, and of course, the protracted Russia-Ukraine war. These are devastating humanitarian crises with immense, far-reaching consequences.
They are. And the direct link to shipping is clear, even if sometimes counterintuitive, as we've touched upon. Wars divert capital to arms manufacturing and procurement, neglecting broader economies and potentially leading to lower demand for general cargoes needed for productive investment or consumption. However, reconstruction efforts, should peace ever arrive, would generate massive demand for construction materials. Steel, cement, bauxite, which would be a significant boon for geared bulkers the segment PSL operates in. The Israel-Iran conflict earlier this year, for example, saw some tankers avoiding the Strait of Hormuz waterway, pushing freight rates for those willing to sail as high as $92,000 per day temporarily.
Wow, huge risk premium. Exactly. This makes us ask, how does the shipping industry navigate the pursuit of potentially high profits in conflict zones against the immense human cost and operational risks associated with such voyages, including the complex moral considerations?
PSL, for its part, has a very clear and firm stance on this, as stated in the newsletter. They do not sail their ships to ports in Ukraine or Russia, nor do they allow them to sail past the Bab el-Mandeb Straits or into the Red Sea, no matter how profitable those voyages might be perceived to be. It's a very strong commitment to seafarer safety and ethical operation over potential short-term profit.
It is. And that commitment to seafarer safety, even at the cost of foregoing potential high profits, is a powerful statement about their values and long-term risk management approach. It builds trust with their crews and insurers. Moving beyond immediate conflict, the newsletter also touches on broader, slower-moving demographic shifts that influence demand. Urbanization, for instance. As more people move to cities globally and increasingly live in single-person homes, demand for white goods, furniture, and building materials, all requiring dry bulk transport at some stage, dramatically increases. Similarly, the rise of a global middle class, particularly in Asia, shifts diets towards more meat consumption. This requires significantly more grain imports for animal feed, again boosting dry bulk demand. These are not sudden spikes, but fundamental structural demand drivers underpinning the market long-term.
So demographics are a slow but steady tailwind for dry bulk. Now, the newsletter takes a strong stance on sanctions. It forcefully argues that they are a largely failed geopolitical strategy, creating far more unintended consequences than desired behavioral change.
Yes, it's quite a critique. And what's truly eye-opening from their perspective is the rise of the shadow fleet, particularly in the tanker sector, as a direct consequence. By forcing certain tankers, often those carrying sanctioned oil from countries like Iran, Venezuela, or Russia, out of traditional insurance coverage provided by the reputable international group of P&I clubs, sanctions have effectively created a parallel fleet of older, uninsured, and reportedly poorly crewed ships operating in a dangerous gray area outside of normal maritime regulations and oversight.
A fleet operating completely off the books, essentially.
Largely, yes. This leads us to wonder, are we, as a global community, inadvertently prioritizing political aims over fundamental maritime safety and environmental protection? This shadow fleet poses a truly significant global risk for oil spills and major accidents in sensitive coastal areas, as these vessels often lack proper oversight, maintenance, and accountability. It's a dangerous hidden cost of sanctions.
And the newsletter provides a compelling example that challenges common stereotypes. An incident near Singapore where an insured tanker owned by Hafnia collided with a shadow fleet tanker. The result was that 2 Hafnia crew members ended up being charged, demonstrating that blame is not always where popular narratives or assumptions might place it. Things are complex out there. Furthermore, the Houthis in Yemen, despite being sanctioned and targeted militarily, continue to develop sophisticated weapons and have recently sunk 2 commercial ships in the Red Sea. This has effectively made it a no-go area for sensible ship owners, as PSL itself has declared, regardless of sanctions. The physical threat is too high.
It shows the limits of sanctions in deterring determined non-state actors and the real-world dangers created when normal maritime order breaks down.
Finally, let's turn to climate change, which the newsletter positions not just as an environmental crisis, but is arguably the overarching challenge of our time and a significant dry bulk market driver itself. Extreme weather, such as record heat waves and droughts in China, can severely reduce crop yields, increasing demand for long-haul grain imports to make up the shortfall. It also necessitates more materials, cement, steel, timber for rebuilding damaged infrastructure after severe weather events like hurricanes or floods. And paradoxically, heat waves generate more power demand, potentially boosting coal or LNG shipments.
Absolutely. This section of the newsletter is rich with evidence of climate change's direct, tangible impacts on factors relevant to dry bulk. The U.S. alone saw $27 billion weather events last year, following 28 in 2023. These are individual events causing over $1 billion in damages each. The frequency is increasing. Record-setting heat waves across Texas, Europe, and China are driving peak electricity demand, straining grids, and influencing fuel choices. Melting glaciers, severe floods, persistent droughts, and devastating wildfires are becoming increasingly common globally, leading to massive reconstruction efforts and disruptions that affect shipping routes and commodity supply chains. However, there's a significant contradiction highlighted here, too. Given that global militaries collectively account for an estimated 5.5% of global emissions, more than the entire aviation and shipping sectors combined.
5.5%, that's huge.
It is. And NATO members are committing to increase defense spending towards 5% of their GDP by 2035. This brings to mind a critical question. How will this enormously carbon-intensive industry, as the newsletter calls it, reconcile its projected growth and increased activity with urgent global climate goals? The two seem to be on a collision course.
That's a powerful point about military emissions, often overlooked in climate discussions. And here's a stark fact that directly impacts decarbonization efforts on land, mentioned in the report. Over $22 billion worth of clean energy investments in the U.S. were canceled, closed, or scaled back in the first half of 2025 alone. This was apparently due to companies reacting to the upcoming rollback of Biden-era green tax incentives under new tax bills signed by President Trump. It shows how rapid policy shifts can quickly derail progress on climate initiatives, creating huge uncertainty for green investments, despite the urgent need for action.
Policy stability is crucial for long-term green investments, and clearly that's been lacking in some areas.
Okay, we've covered a huge amount of ground, from detailed financials to global megatrends. Let's try to wrap this up. So what does this all mean for you, the learner, the informed citizen, trying to make sense of our complex, interconnected world? We've truly delved deep today. We've explored PSL's remarkable resilience and operational efficiency amidst significant market challenges and currency fluctuations. We've navigated the intricate dance of global trade and geopolitics affecting the dry bulk market, the tariffs, the rerouting, the regional shifts. And we've examined the immense shifts underway, from the industry's arduous decarbonization efforts under IMO rules to the absolutely insatiable energy demands being driven by artificial intelligence.
Yeah, I think the key takeaways from this deep dive are that the dry bulk market is currently in a period of intense flux, really defined by dynamic and often contradictory forces. It's influenced by both tightening supply fundamentals driven by those EEXI regulations slowing ships down, an aging fleet, historically low new orders, and maybe eventually more recycling, and powerful demand shifts originating from geopolitical rerouting boosting ton miles, China's cautious economic recovery, the rise of India, and these unprecedented new energy demands fueled by AI data centers. The financial and environmental implications of the new IMO regulations starting in 2028 are significant and will only grow, making proactive fleet management, like PSL seems to be doing, and robust long-term sustainability commitments absolutely vital for any shipping company's future success and profitability. You can't ignore ESG anymore.
Absolutely. So here's a final provocative thought for you to mull over as you go about your day, building on everything we've discussed. As the world grapples with escalating geopolitical instability across multiple regions, the truly insatiable energy demands of artificial intelligence fundamentally reshaping global power grids, and the intensifying reality of climate change, altering weather patterns, disrupting agriculture, and impacting trade routes. How might these converging forces fundamentally reshape the very definition of a safe or profitable voyage for a dry bulk ship in the coming decade? And perhaps more importantly for all of us, what unforeseen impacts might this have on global supply chains and, ultimately, the prices and availability of the everyday goods that fill our lives, from your morning coffee beans to the construction materials in your home or office building? Something to think about.